thinks could be the impact as well of this kind of move by the RBI. To discuss this further and to break it down into the impact that we could see on banks, on NBFCs, we have Pranav Gundlapalle, Senior Analyst of India Financials at Bernstein, joining us now. Pranav, thanks a lot for joining us. Like we were mentioning on the personal loans part, yes, this was expected. I think where it goes beyond it was on the NBFCs, on the credit cards as well. But take us through what is the kind of impact that you are expecting, considering that almost a third of the personal loans are unsecured for the banks.
Right. See, I think, first we need to just understand the context here. I think you've had 2 to 3 years of extremely rapid growth in consumer loans. And this rate, this increase in risk weight is in effect a way to increase the lending yields on these segments. And it's not a bad move, because if you look at the yields on these products over the last 18 months when the benchmark rates have gone up, the yields haven't really moved up. So it's in a way RBI's way of saying the banks that they would need to price these higher, which would automatically bring down the growth rate to a certain extent. So if the growth was being led by unnaturally low interest rates, that would get corrected along the way. So I think that's the way I see this. And therefore, in terms of the impact, the immediate impact on capital ratios will be fairly minimal and quite manageable for most banks, given you're talking about less than 70, 80 bips on the capital impact. Most banks are sitting with significant amount of extra capital, so that will not be a direct impact today. But these products get more expensive for banks to lend because of the higher capital charge, and therefore you should expect a higher pricing for a lot of these products. So that is the first part on the banks. I think the second part is that for NBFC, it's a double whammy, right? Because A, they have the higher risk weights to deal with, which is the same as the banks, but they also will likely face higher cost of funds because the banks lending to NBFCs will now involve a higher risk weight. And here again, the banks are likely to raise those rates in order to account for the higher capital charge. So a double whammy for NBFCs, which means you will see a sharper slowdown there versus what you might see in the case of banks. So, which again is probably an indication of where RBI sees greater uncertainty or need for caution with regards to these segments.
Pranav, hi. Good morning. Appreciate you joining us in over here. So, two aspects of it. One is the additional capital that banks and NBFCs will have to raise. And you said that should be a minimal impact. So I'm going to focus more on growth, because this was the high growth, high yield portfolio for both these, lenders, right? Banks and NBFCs. We were speaking to one banker today, Bank of India, and we were trying to get an answer whether in terms of just intent and, a risk appetite going forward, whether they will incrementally go slow on the personal loan segment. The answer for Bank of India was no. But what is your sense? Will banks simply pass on the higher cost and keep lending? Or do you think there'll be a change in track?
I think banks will pass on. So two things will happen here. So one is banks will have to pass this on because in effect, this is a selective rate hike that is being done by RBI, right? So they need to pass this on. So it remains to be seen how much does this translate in terms of a slowdown in growth. I think you might see a marginal decline in the growth rates. But what it also does is it makes the other segments attractive for banks. So if you've seen what has been happening in the last few quarters, you've seen a significant shift for many banks away from segments like mortgages and corporate loans towards these loans, because they potentially provide a higher return on risk-weighted assets, right? So now that has been normalized. So bankers would be incentivized or the incentive to do corporate loans and other loans would probably go up now relative to these personal loans. So you might see a bit of that shift in growth, but would a 1 to 2 percentage point increase in the yields dramatically slow down the personal loan growth? Maybe not, because you're already talking of loans which are, in double digits. The EMI impact of 1 or 2 percentage points increase will not be that significant to get a consumer to say no to a loan when he wants it. So that impact would be quite limited.
Well, Pranav, Abhishek, this side now, you spoke about, shifting of, loans for NBFCs. Now, NBFCs also over the last one and a half year have moved away from, a bond market or, paper, commercial paper market to borrowing from banks. So their bank reliance in the balance sheet in terms of borrowings have increased over the last one and a half year is what I've seen amongst various NBFCs. So how much will cost of funds actually rise for these, lenders or NBFCs who continue to borrow from banks? That is question number one. And question two, what will be the hike in lending rate to NBFCs from banks that you foresee?
Okay. See, I think, the obvious reason why they shifted to banks was because this was slightly more cheaper versus the other sources. Now, if the way to think about this would be to say, what is a change in the risk weight, right? So the regulation suggests that or stipulates that the risk weight increases by 25 percentage points from where it is today for those loans where the NBFC's risk weight based on the credit rating is less than 100%. So if, for example, the risk weight of an NBFC is 30% today, that increases to 55%. So it means the risk weight almost doubles up, right? So then if you then calculate the impact on, therefore, the cost of lending to those NBFCs, if the banks were to maintain the same return on risk-weighted assets, which would translate to same ROE, then, for an NBFC with a risk weight of 30%, they might almost have to increase the cost of lending by 1 to 1.5 percentage points. So that could be quite a meaningful jump for some of the best-rated NBFCs. Now, again, it might not go down to that extreme level. It might be somewhere in between where the bank takes some hit and then lets the NBFCs, absorb in certain increase in the cost of funds. But the maximum limit is about 100 basis points.
So yeah. Pranav, just to come in over there, just to simplify this for us, if I ask you sort of a ballpark question, what could be the margin compression that NBFCs may have to see? Because there's this competitive intensity as well, right? As you're saying, if they hike up rates by 100 basis points in the market, consumers may not have any incentive to take that NBFC loan, right? So given all this, net, what's the margin compression we may be looking at? Anyway, we were looking at compressing margins through the course of this year, and now you have this added move. So what are we talking about? Margin compression for banks as well as NBFCs?
See, I think the margin compression for banks would be minimal because there's no cost of funds impact. For NBFCs, it could be as much as 30 to 40 basis points, right? If you take the 100 basis points and then multiply the amount of bank funding. So 30 to 40 basis points, especially in segments where banks are also active. Now, remember that this is an industry-wide trend or industry-wide impact for NBFCs. And therefore, if it's a segment where banks don't play to a large extent, they can probably pass this on to the consumer. But in segments like, say, in auto loans, where they compete with banks, they would be at a disadvantage and therefore will probably absorb the entire impact of cost of funds increase. And therefore, that translates to a NIM decline straight away.
Well, Pranav, over the last couple of years, the risk-weight asset to loans have been on a declining trend, despite the fact that, retail loan growth has been pretty strong for lenders, especially the banking community. So in terms of rating profile, do you see any changes in the rating profile of either banks or NBFCs on account of this move from RBI? Any risk that you foresee, in terms of rating change? Because apart from the fact that cost of funds will increase on the interest rate side, a decline in rating also can impact your overall portfolio or your ability to borrow at competitive rates, right?
Right. See, I think this would be an issue for some of the NBFCs which are entirely focused on the retail segment, especially retail unsecured segments. So like an SBI cards, for instance, where the impact on capital could be significant. So your capital buffers will start to decline. So that could impact ratings. But for the more diversified NBFCs and banks, the change in capital ratio is so small that, you can literally cover it up in a quarter or two. So through your earnings. So it might not really translate to a credit rating change as such.
Okay. Pranav, we've discussed the measure, its implication, the analysis quite a bit. Now let me come down to the stock question, right? Sometimes these events do present a good buying opportunity. So what would you advise people to do? And this is more from a portfolio perspective. I'm not talking about trades here. But from a portfolio standpoint, banks, large banks, which anyway have been underperforming, NBFCs, what would your top bets be?
See, I think my top picks would be the large banks at this stage. The large top 4 private sector banks look extremely attractive versus the rest of the banking sector, at least, of which HDFC is my top pick, just given the amount of ROA improvement that can happen over a period of time. So I think within the banks, the answer is simple. And also in terms of growth as well, the smaller banks who have been dependent more on the unsecured loans, the personal loans for their growth, will find it hard to switch into, say, a corporate loan or some of the other segments. Whereas the large banks have the flexibility to switch, which would help them to maintain growth to a large extent. So within the banks, I think the preference would be for the large bank, especially HDFC. Now, if you go to the NBFC universe, I think there are 2 things which I would look out for. One is lesser exposure to the unsecured retail would have lesser impact on capital. So it goes back to that argument on risk weights and credit ratings, etc. So SBI cards would be something I would avoid at this point. Whereas the ones where the NBFCs compete less with banks, so think about smaller ticket loans, segments that banks don't compete in, those might almost be immune from this because they can just pass it on to the consumers and let pretty much the entire industry pass it on to consumer, and there the only impact would be a slightly slower growth potentially from the higher rates. So for example, a Paytm could largely see that it can maintain its take rates and yields because they can pass it on to the consumer. So I would be more positive on Paytm, less on SBI cards.
Okay, got that. Pranav, thanks a lot for joining us and helping us make sense of, the kind of impact that we could see across the financial space because of this new rules that have come through on unsecured lending. But with that, we do need to take a short break on the show. When we come back, we're going to shift focus to the market, which, by the way, has moved back into